Hello friends and welcome back. If you own your home outright or you're paying it off, there's something you need to hear before you make another move with Centrelink. Owning your home is supposed to be the safety net. It's the thing that's meant to make retirement easier. But right now, in 2026, that same home is quietly deciding how much pension you get, whether you qualify for a part payment at all, and what happens the moment you think about selling, renovating, or borrowing against it. And here's the part almost nobody explains properly. The rules aren't the same for homeowners as they are for everyone else. Centrelink treats you differently the second you tick that box, and most people don't find out how differently until they've already made a decision they can't take back. I've gone through 5 of these rules today, the ones that actually change what lands in your bank account. Some of you are going to hear Rule 2 and realize you've been sitting on a ticking clock without knowing it. Others are going to hear Rule 4 and realize there's money sitting on the table you didn't know you could claim. Stay to the end, because Rule 5 is the one almost nobody asks about, and it could be the difference between selling your home and never having to. Before we get into it, if you're not subscribed, now's the time. Here's why that actually matters for you specifically. The asset limits, the exemption periods, the interest rates on government loans, all of it gets reviewed and adjusted multiple times a year, March, July, and September. Centrelink doesn't ring you up and explain what changed. They update the policy, and if you're not paying attention, you find out the hard way, usually after a payment's already been reduced. The people who subscribe to this channel hear about these shifts while there's still time to act. The people who don't tend to find out after the fact, when the fortnightly deposit is smaller and there's no going back. So hit subscribe, turn on notifications, and let's get into the 5 rules. Rule 1. Owning your home doesn't remove you from the assets test. It changes the test entirely. Here's the bit that catches people out straight away. Your family home itself is exempt. Centrelink doesn't count the roof over your head as an asset, and that's not changing. But the moment you're classified as a homeowner, every other threshold in the assets test drops. You're now judged against a tighter limit than someone who rents. Right now, a single homeowner can hold up to roughly $321,500 in assessable assets, savings, shares, your car, a caravan, superannuation once you're of pension age, and still receive the full age pension. Go over that and your payment starts shrinking by about $3 a fortnight for every $1,000 above the threshold. Keep climbing and somewhere around $722,000 in assessable assets, the pension disappears completely for a single homeowner. Now compare that to someone who doesn't own property. A single non-homeowner can hold assets up to roughly $579,500 before the full pension starts reducing, and their cutoff point sits much higher again because Centrelink assumes a non-homeowner needs those extra savings to cover rent for the rest of their life. It sounds fair on paper. In practice, it means 2 people with the exact same superannuation balance can receive completely different pensions purely because one of them owns a house and one doesn't. Why does this matter to you right now? Because a lot of homeowners assume owning their home outright is a form of protection from the assets test. It isn't. It just changes where the line sits. If your super, savings, and other assets are creeping toward that lower threshold, the pension you're expecting might already be shrinking without you realizing. The asset test, not the income test, is the one doing the damage. Rule 2. Selling your home starts a clock, and most homeowners don't know how long they've got. This is the rule that trips up more homeowners than almost anything else on this list because it feels like it shouldn't apply to you until the day you actually decide to sell. Say you sell the family home to downsize, move closer to family, or head into a retirement village. The moment that sale settles, the exemption on your home disappears and the proceeds officially become cash. Normally, a sudden 6- or 7-figure deposit like that would smash straight through the assets test and could wipe out your pension overnight. Centrelink knows this happens to genuine downsizers, so they built in a safety window. If you intend to use the proceeds to buy, build, or renovate a new principal home, that portion of the money stays exempt from the assets test, but only for a set period. For most people selling today, that starting window is 12 months, automatically extendable to 24 months if you're still searching or your build is delayed, and in genuinely tough circumstances, like builder shortages or something beyond your control, it can stretch to a maximum of 36 months. After that final deadline, whatever's left over gets counted as a standard financial asset, full stop. Here's where people get caught. Say you sell for $750,000 and you're planning to buy something for $500,000. That $500,000 stays protected while you're settling into your next place, but the remaining $250,000, that's assessed straight away, as though you already had it sitting in the bank. And during the whole exemption window, Centrelink still applies what's called deeming. They assume your money is earning a set rate of income whether it actually is or not, and that deemed income can affect your payment under the income test even while the assets test exemption is protecting you. The part almost nobody mentions, you have to tell Centrelink within 14 days of settlement what you intend to do with the money. Miss that window or change your mind without notifying them and the exemption can be pulled. If you're thinking about selling this year, get the timeline in writing and mark the deadline on your calendar the day the contract goes unconditional. Don't wait for Centrelink to remind you. They won't. Rule 3. Putting your sale proceeds into super doesn't make them invisible. This one surprises a lot of retirees because putting money into superannuation feels like tucking it away somewhere safe from means testing. For homeowners over 55 who've owned their place for at least 10 years, there's a genuinely good opportunity here, the downsizer contribution. It lets you put up to $300,000 each, or $600,000 as a couple, from your home sale straight into super, outside the normal contribution caps, no tax deduction needed, no upper age limit. But here's the catch that catches people out. Once that money lands inside your super account and you're already at pension age, it's no longer invisible to Centrelink. Superannuation held by someone who's already reached pension age is assessed under both the assets test and the income test, the same as money sitting in a term deposit. The tax advantages inside super are real. The Centrelink protection is not automatic. So if you're weighing up a downsizer contribution, the real question isn't, will this boost my super? Of course it will. The real question is, what does this do to my pension the moment it lands? For some people, especially part pensioners already close to the upper asset thresholds, tipping a few $100,000 into super can be the exact amount that pushes them from a part pension to no pension at all. For others, with plenty of headroom under the limits, it barely moves the needle. There's no one-size-fits-all answer here, which is exactly why so many people get it wrong. They assume super's a shelter, when for pension purposes, once you're of pension age, it usually isn't. Rule 4. Putting money into your home can quietly increase your pension. Now here's one that works in your favour, and it's the one I want more of you to actually hear, because it's the opposite of a trap. It's an opportunity most homeowners never think to use. Because your principal home is completely exempt from the assets test, any money you move out of assessable assets and into your home effectively disappears from Centrelink's calculations. Renovate the kitchen, replace the roof, put in a new bathroom for accessibility as you get older. That spending doesn't just improve your quality of life, it can reduce your total assessable assets, which for someone sitting near a threshold can mean a higher pension payment, sometimes for the rest of your life. Think about it this way. 2 retirees each have $360,000 in savings on top of an exempt home. One leaves the money in a term deposit, it's fully assessed, and it's reducing their pension fortnight after fortnight permanently.
The other spends $80,000 upgrading and future-proofing their home. That $80,000 is now inside the exempt asset, off Centrelink's books, and their pension recalculates upward from that point on. Same starting wealth, genuinely different fortnightly outcome, and one of them is living in a nicer, safer home while they're at it. This isn't a loophole, and it's not something dodgy. It's built into the rules deliberately, because the government would rather you invest in a safe, comfortable home than watch your pension get eaten away by savings sitting idle. The mistake most homeowners make is never connecting the dots between "I want to renovate" and "this could actually increase what Centrelink pays me." If you've been putting off a home improvement because you're worried about the cost, it's worth running the numbers, because in some cases the pension increase does a lot of the heavy lifting. Rule 5. You don't have to sell to access the equity in your home. This is the rule that surprises people the most, because most retirees assume there are only two options when it comes to their home: keep living in it with no extra income, or sell it and lose it. There's a third option, and it's run directly through Centrelink, not a bank. It's called the Home Equity Access Scheme, and it lets homeowners at pension age borrow against the equity in their property, either as regular fortnightly top-up payments or as lump sum advances, without selling a single square metre of the place you live in. As of 2026, the interest rate on this scheme sits at 3.95% per annum, considerably lower than most commercial reverse mortgages, and it comes with a no negative equity guarantee, meaning you or your estate will never owe more than the home is actually worth, no matter how long the loan runs or what happens to interest rates down the track. You can draw it as an ongoing fortnightly amount up to a combined limit of 1.5 times the maximum age pension rate when added to your existing pension, or you can take up to 2 lump sum advances a year, each capped at half the annual maximum age pension rate. Nothing gets repaid until you choose to close out the loan, sell the property, or your estate settles it after you're gone. Why does this matter so much for homeowners specifically? Because it's built entirely around the fact that you own property but might be asset rich and cash poor. A lot of super, most of it tied up in bricks and mortar, not much coming in fortnight after fortnight. Instead of downsizing to a smaller place you don't actually want, or watching your savings run dry, this scheme lets your existing home quietly top up your income while you keep living exactly where you are. It's not right for everyone, and it does reduce what's left in your estate over time, but it's an option most homeowners never even get told exists.
Putting it all together. So here's where that leaves you. If you own your home, the asset test still applies to you, just with a different, tighter set of thresholds than a renter faces. If you're thinking about selling, there's a strict, time-limited exemption window on the proceeds, and missing the paperwork deadline can cost you the protection entirely. If you're planning a downsizer contribution, remember that money inside super at pension age is assessed, not hidden. If you've been sitting on savings instead of maintaining or upgrading your home, that decision might be quietly costing you pension money every single fortnight. And if you need more income without giving up your address, the Home Equity Access Scheme is worth a serious look before you ever put a for sale sign on the lawn. None of these rules are secret exactly. They're all sitting on the Services Australia website if you know exactly what to search for. But nobody sends you a letter walking you through how they apply to your specific situation, and that's exactly where homeowners lose money without ever realizing it happened. If this cleared something up for you, do me a favor and share it with someone you know who owns their home and is either retired or getting close to it. A parent, a neighbor, someone at the bowls club who's always asking about this stuff. And subscribe, because these thresholds move again in a few months, and I'll be breaking down exactly what changes the moment it happens. See you in the next one.